Good day, folks. Welcome to Section 2, Economic Growth Measurement and Forecasts. So we're going to start with some basics here that you already know, but I want to keep things in context because business decisions and strategies and plans revolve around this. GDP, total GDP, which is the gross domestic product of a country. It's often expressed as a percentage to prior year or quarter. Trends are more important than a point in time, as we will see. It's complicated, includes other statistics and estimates. It's not always timely, preliminary, and final. So it takes time for it to actually come out. The GDP as a whole is a primary indicator of the health of a country's economy. It is a measurement, at a point in time. If it's healthy and it's growing, we tend to have low unemployment, wages increase as business demand more labor, and to meet the growing economy. It builds confidence. When we're growing, you feel good. Growing too fast, inflation can be a risk. Negative growth, less jobs, less production, creates negative feelings. 2 quarters of negative growth is a recession. Let's now look, we call this the GDP, and what I'm showing you here is the third quarter, which was last revised on the 22nd. The next release is not until January 28th. And what I've outlined here are the key components. The first thing you can see is, if you're looking here, the total gross domestic product. This is the value of the goods and service produced in our country on an annualized rate. It's made up of personal expenditures, gross domestic private investment, that's what companies spend to make things, net exports of goods and service, and government consumption. And as we can see, here we are in the fourth quarter. A year ago, we were at 21,747. Then we had the first quarter, which only had the partial impact of COVID, but it's down. Then we dropped down to 19,520,000, and now we're back up to 21,1. But if you look, we're still not at the running rate of 2019. In fact, it looks more like the first quarter. So we've had a setback. And if we look at most of the change, we'll see that a lot of the change was right here on the consumer side. But just to give you a sense of the size of the U.S. economy, about $21 trillion, which is a lot. When we look at it as a percentage change from period to period, and I went back to 2003, and you can see it's not really ever gotten high. Here was the Great Recession, and this was the sort of the first pop. Then it went down, then it went down, down, down. It took so we had a pure recession here. This is the beginning of COVID, and you can see that it's down and it backed up on a percentage to prior period. But this was deeper what we saw this year than prior year. Now, this is this chart here shows you on this line right here. Here's the actual GDP, and here is the trend. Had the trend continued, the 2009-2019 trend continued, this would be the GDP. Now, what we've seen is this actual, it's coming back, but what you see is a base case scenario and then a delayed vaccine. So it doesn't appear that through 23 it's going to take us quite some time to get back to where we were in 2019 on that run rate. So that's what we're looking there. It's the hope that the coronavirus vaccine will help get things back together. What do we see in the coming 3 stages for the economy? A slow growth, probability that the Fed will ease conditions, divided government will struggle to deliver meaningful fiscal stimulus. We see that today. The 10-year rate will vary between 0.75 to 125. Equity markets, I think we're going to see very volatile. They're going to wrestle with vaccine optimism, elevated valuations, physical impacts, and I think we're going to see the dollar strengthen. So that's the next 1 to 5 months. Once we get into the temporary 2Q21 to 4Q21, assuming that vaccine progresses, we're going to have inflation, okay, to get things going. Limited fiscal support at best. That means the government isn't going to spend. Rates likely will range from 1 to 1.5. And again, equity markets are in the middle. Dollar-like ones. 22 and beyond, sluggish growth and tepid inflation. Things that we talked about already, debt, populism, globalization, globalization, I'd suggest globalization. Fed keeps the rates down. Stagnant or contractionary policy could flatten out GDP. So this is sort of the stages that we're going to look at. I put in 2 growth scenarios. This one is from Goldman Sachs, which is they are predicting for the world for 20 a contraction of 3.9, 3.5 in the U.S., 5.3 in Germany, 7.2 in the euro. China, positive. India down. Brazil. For the world, they're predicting 6% next year. U.S. going from negative 3.5 to 5.3. That's a lot of growth. And that's assuming that the virus vaccine works. And we can see tremendous change here in China and India. So this is what Goldman Sachs is looking at. This one I bring over from Charles Schwab, and they're a little more pessimistic, believing that the U.S. is going to be about 3.1, Germany about 4.2. They're seeing China at 8. If you come back here, Goldman is seeing China about the same. Us 5.3 in the U.S. They're only seeing us at 3.1. So there are some differences here. Just to give you a sense, this is the global economy where things are produced. You can see that we're 24% of the global economy. Now remember, we're only about 4% of the population, so we have a disproportionate share. And if we take some of the growth rates that we've been experiencing and you extrapolate them out, China will clearly exceed the United States by 2050. The growth, as we can see here, is coming entirely from China and India, as the U.S. is relatively stable. I'd like to caution you on using GDP because there's so many different things that go into it, and I don't think it really captures the impact of technology, improvement in lifestyle. We need to be cautious about forecasting and nowcasting. We need to know where the direction is going so that we can develop strategic plans, implement them, determine the profitability, and chart our future and what we need to do. So that wraps up the GDP. The next thing we're going to take a look at is the labor market. We're going to take a look now at employment information. The first thing we need to talk about is the labor force participation rate. Important that we start here so that we can understand unemployment within the context. And this is a chart, that's what percent of the population is in the workforce working or looking for work. And if you go back to 2000, about the same time, November 2000, you can see that we're probably at about 67.5% of the population working. What that means is that if 67% is working, 33% is not. That includes elderly, those under 18, and those not in the workforce for one reason or another. Okay? Now it dropped to just a little bit over 60.5, and here we are a few months later, we're still at about 61.8. So that means since the beginning of this, about 8 million Americans left the workforce between January and November. They're not looking for work, but they left the workforce. Did they retire? Yes, they could have retired. Are they taking care of family? Are they taking care of children? Yes, but the 8 million, keep that number in mind. Now we look at the unemployment rate, and as you can see, I set this up from 1950 to current. And as you can see in November, it's 6.7%. Now, the dramatic increase was a result of COVID, was the highest level of unemployment we had since before World War II, during the Great Depression. But it's bounced back reasonably good. But if you look at it, it is just about where things were in 2008 when we were in the recession. Now, you can't just look at that, as I said, in isolation. You have to look at the number of people in the workforce. So if you had more people here with a lower unemployment rate, you have these folks here who are not working. And if we take 6.7%, that's about 21 million, and you put them together, we got about 30 million people not working that have work. Remember, these are people that spend money. Now, when we look at, there's different measures of unemployment. And the one that I just want to note is what's called U6. And this is total unemployed, plus all marginally attached workers, plus total employed part-time for economic. Okay? So we're really seeing at about 12% when we look at that. And that's a lot of American people that are either unemployed, marginally attached to something, or part-time for economic reasons. So, I mean, we really got a long way to go. And this COVID crisis is hitting what we'll call diverse employees hard. And all employees are struggling, as you can see here. 62% of respondents are concerned with their own mental health, behavioral health, which we talked about previously. Hopefully you watched that video. 60% lack of belonging. Female employees are 1.5 times more likely to be concerned about challenges. Same thing here, people of color, parents, and we're trying to do that, but there's a lot of gaps. So it's really hit our diverse employees hard, which isn't that unexpected, because I'd like to introduce to you this concept of low-wage workforce. These are the people who have been adversely impacted. And when I first saw these numbers, I was shocked. Okay? So what they did is they broke all workers down between 18 and 64. They called 43% are low wage when they sorted them, 56% high. And when you look at the employed versus unemployed, low wage workers tend to be a little bit more unemployed. Worked only part of the year. Look at this right there. Average median hourly earnings, 10.22 per hour. That's $17,000 a year. 18,000. So think about that. 44% of American workers make a median of $17,953. That's pretty low. High, when you look at the gap here between high and mid-range, our hourly earnings are 26, 1022. So this is really quite a phenomena that we're seeing, but we have this divergence in the workforce, and of course wealth goes along with that. Low-wage workers tend to be more people of color. Now let's take a look at how growth has happened since 1970. When we take the bottom 50%, in 1970 they made 19,640. Remember, it was only 44% in the other one for 17. That's now up 27,000, 41%. Okay, but then we go to the 50 to 90, was 44, went up to 75. Their increase was 72. The top 10 to 1% was up 105. Top 1% was up 250. The top 0.1 up 412. So what we've had is a disproportionate share of income and being at the higher levels they've gained more than those in the lower. But we're still looking at a very low wage, relatively speaking. Now, some of this comes back to education, and educational attainment. And as you can see, everybody suffered here. But bachelor's degree, which you're working on now, the unemployment is only 4.2%. It did not go up as much. And it has been, even in the Great Recession, it did not go over 5%. So you're in a lucky group. Now, that might say, well, it's a function of education. Well, let's just take a look for a second. College education, which you're doing today, 4-year degree or higher. When I graduated from college in 1977, that's a few years ago, 34% of the American people had a 4-year degree or higher. Think about that. What do you think it is today? Nope, it's 38%. Not much of an increase. By states, it varies from 28 to 50%. In New York State, where we live, much more educated and closer to 50%. When we look at other countries, though, today, Canada, 56%, Japan, 51%, Israel, 50%, Korea, 47%. So what's happened is that in the U.S., we've stayed relatively stagnant with those that are educated over the past 40-some years. So I think that's important, but that's leading us to, that's going back, if we just step back for a second, that these are our low-wage workers, a significant proportion. There's a relationship here. Now that I'm putting into context for both finance and for organization behavior. So that wraps up our economic current situation and forecast. Next thing we're going to take a look at is going to be policy.